Underway with the morning briefing and recapping some of the major news that's come out from overnight in what otherwise was a particularly quiet day yesterday. Wasn't really a great deal on the calendar, a lot of focus still on the geopolitical news given the Syrian airstrike we had last week, and still very much it kind of is a follow through of that subject matter, I would say, in terms of what's driving the markets and sentiment at this particular point in time. A quick look at the US indices, because a lot of you may have already wrapped up for the day at the time when it came, but you had after the European cash close. I'm still here just finishing up on a few things, and you started to see a bit of a sell-off into 5 o'clock yesterday afternoon in US equities. A combination of a bit of a technical play in regards to the respective pivots on the day in the likes of the Dow and the S&P just gave way. They just saw a bit of an extension of the selling after technically it broke some of the morning's lows. There was a bit of circulation though of a news article on this kind of geopolitical theme. If I just quickly change my screens. So quite a few people were passing around this particular article. It came out of Korean press, also similar type headlines coming from Japan, and so it was more of a pinning a story to a move, I think, rather than anything that was outright new information, because this story actually came out a good kind of 20 hours or so before that move in the late afternoon yesterday really took hold. But you know, as per the way that news gets disseminated, it's only when people, you know, circulate it, more people are aware of the article, that sometimes it gathers a bit of interest and momentum. And essentially what it was talking about was the way that China potentially are positioning themselves in response to the movement of US naval ships moving to Singapore. So in the South China Sea, the Chinese army reportedly is said to have deployed 150,000 troops in 2 groups to prepare for unforeseen circumstances. And so they're said to be situated moving towards the Yaolu River. For those who are not familiar with where that is situated, if we just quickly look at this map, you can see China here, Beijing, obviously northeast. But then if you look to North Korea, where we are, that river essentially marks then the border territory between China and North Korea, where this report suggestive that China are amassing troops. Now, when you hear this type of news, it's not that they're amassing troops to go to war, it's more of a showing of military power, and as we said yesterday, a flexing of muscles, so to speak, that you know, they are also able and capable from a military point of view, ready to kind of go. If the US are willing to show how forceful they can be, China can do the same quite quickly. But what that's led to is a general kind of negative sentiment still lingering in the market. If you look at the Japanese yen, that's acted as a fairly good barometer of market kind of feeling, if you like, as gold. And looking this morning, dollar yen, as you can see on the left, I've got dollar yen here and gold. Both are reflective of that kind of moderate flight to quality kind of move. Dollar yen having just trended lower ever since yesterday afternoon, and the yen stronger overnight. In comparison, gold having touched that low just after 1 o'clock yesterday afternoon, we've continued to kind of edge higher. And just edged up again overnight in Asia trade, albeit in a relatively mild fashion. So I would definitely be looking at things like the yen and gold to act as a bit of a barometer to how the market is feeling over this geopolitical situation, which has obviously become, following those Syrian airstrikes, a more dominant theme for markets, given it's been fairly quiet in terms of economic data and things like that, to speak of more recently. The one thing though, with gold up and WTI crude having moved up higher yesterday, obviously reclaiming a $53 handle, the ASX, which is the Australian benchmark stock index, outperformed last night, whereas the Japanese Nikkei 225 underperformed because of the weight felt for those export names which weighed on the local index. So you've got a bit of disparity between the performance where the resource-heavy Aussie index was lifted by gold and crude more recently, which have been fairly well bid, whereas the Nikkei suffering from that kind of flight to quality move into the Japanese yen, impeding those export names. So looking at this morning, you've had a slight negative open for European indices, nothing really too forceful, I would say, finding a bit of support in the DAX future around that S1 initially, sitting around that 12,200 level. Quick look elsewhere then at some of the other headlines just to wrap up on this. On the geopolitics, you've got the G7, obviously they were meeting in Italy. They're meeting again today, and this is kind of the front-running meeting ahead of the US Secretary of State Rex Tillerson meeting with Moscow. I believe that's on Wednesday. This follows his weekend comments calling Mr. Assad's a murderous regime. This, of course, coming as the G7 look to see what they can do in order to... what they want to do is have dialogue as the main weapon to try and talk with Russia. Reading some of the articles this morning, they're saying that basically it's going to take too long for them to enact actual renewed sanctions, of which the Western powers placed upon Russia in years gone by, and so instead what they want to do is bring them to the table for talks. What they certainly don't want to happen is to back Russia into a corner, when then this whole situation likelihood would, in that scenario, just escalate and obviously create more negativity around the situation in terms of a market impact. Then you'd be looking for further of those trends of investors moving in the short term to safer assets, so things like gold, the yen, treasuries and so on. Other news last night, you had Fed Chair Janet Yellen did speak. Relatively dull, I would say, was the kind of vibe that came from that discussion, which lasted over an hour. Essentially saying appropriate stance of policy is now closer to, let me call it neutral, she said, and that we want to be ahead of the curve and not behind it. So Fed focus has shifted to holding growth gains. So any kind of fear that was prevalent maybe 2 months ago in a run-up toward that March 15 hike about the Fed getting more aggressive in regard to their rate hiking cycle, that's certainly dissipated, and the Fed seem to be just in a bit of a holding pattern now, pretty comfortable with their current summary of economic projections, and the fact that we'll likely get 2 more rate hikes this year seems to be something well within their path of delivering at this point. So not really a great deal to add from Janet Yellen last night. Other things though that are kind of simmering in the background, I would say. Definitely attention has been diverted from a broader perspective, but this is still, market positioning has started to occur, and that is the French election. So the French election really is only about 2 weeks away, and yet because of what's happened, this escalation on the global news front from the Syrian situation, it's kind of attention's been diverted, at least in the short term. What's happening here is a couple of charts I just want to quickly show you, and then we'll have a quick summary of what the latest is with the French situation. And it is the market, some would say, has been slightly complacent in toward the prospect of pending volatility around this French situation. Obviously, we've been caught, the market, wrong side of the EU referendum, Brexit, and also Trump, and so the hedging against that has started to be evident in market pricing. So the cost of hedging against declines in the Euro Stoxx has now moved to its highest level since the EU referendum. So just looking at this chart here, you can see there's been a huge upsurge only really since we've gone into the month of April. You can see this is kind of what I talk about often when I deliver the news lecture, about how you have multiple macro themes all running at one time. However, one subject tends to dominate the overall driving force on the fundamentals. And what's happening is The market's been sidelined by other factors pretty much through the beginning of the year, but as the clock ticks down to actual first round voting at the end of this month, now you're starting to see a bit of the price action happening. So although the actual Euro Stoxx has remained relatively steady, you've had a massive upsurge in 1 month, basically, volatility options. Taking a look at what else that we've seen, if you were looking at the CAC Courant, so the actual French stock index itself, the measurement of volatility expectations has risen for 9 consecutive days. So that's the longest streak since August of 2011 in terms as well of the volatility index. So your gauge tracking bets for French stock swings have continued to increase, and you would expect that probably to continue to be that case going forward. So one of the things is then, what is the situation, what's caused this renewed kind of uncertainty? And one of the things here is about this 2-horse race has suddenly looked a little less likely. It's still definitely the baseline scenario that it's going to be a Macron-Le Pen runoff. But really, if we're looking at this first round, the premier tour, if you like, it's Mélenchon, who's here, the red line that has grown considerably in the polls over the last kind of week or two, to the point where in some polls has actually jumped above Fillon. And so what we're looking at here is a situation where someone who is a relative outsider has kind of complicated the picture slightly by the fact that maybe it's not quite such a straightforward done deal in terms of Macron-Le Pen. One caveat though, I'd say, if you've read your Deutsche Bank research this morning, that Deutsche Bank economists in France have noted that 2012 Mélenchon also witnessed a similar surge in polls at the same point in the campaign, but ultimately that surge in support did not materialise in the first round, and he was not close to qualifying in the second round. Now, they do, however, highlight that this time might be different because he appears closer to the top 2 in the first round polls, but this also means that his radical programme might ultimately push moderate voters back towards mainstream candidates. You know, his kind of view, or his manifesto, is very much that we need to have extreme levels of taxation on the rich. They need to pay for social security for the poor. We need to have strong levels of reforms over the EU, in fact a referendum on that case. We need to legalise cannabis. We need to, you know, some of the policies are very, you know, out there to a point where I think so radical that in some extremes it will probably mean that the more on the fence voter would likely steer towards being more comfortable with a centrist candidate. That's why that if you look back historically, people like Fillon, although he suffered out of the number of allegations that have been put his way, actually because he is a more centrist candidate and someone who's very familiar to the voting public, he is someone who generally might actually perform better than the polls have been indicating. But obviously Macron also fits that mould, being of a centre-left orientation. So definitely this French situation, although it's not having a direct read across, I'd say, in regards to translating into trading the euro outright at this present point, I would say that interest over France will likely intensify, maybe not this week, but after Easter, because once we come back from Easter and we get the ball rolling after Easter Monday, you're going to be looking at the 18th, and then really you're in your final 1 week runoff into the actual voting deadline. At the moment, attention is very much more derived from the Syrian and geopolitics situation. Okay, quick look at the calendar for today. There are a couple of things I want you to be aware of, most notably being UK CPI. That's coming out at 9:30. Now, the median consensus for the in-focus year-on-year reading is for inflation to remain steady at 2.3%. Now, if you look at inflation last month, expectations were for 2.1%. So we exceeded expectations, and seeing a 0.2 percentage point beat for a reading like CPI is actually fairly large, going off the historical kind of surprises that you get on this data set. It's the highest inflation rate now we've had in the UK, of where we currently reside, at 2.3% since September of 2013. And obviously it's above now by 0.3 percentage points of the Bank of England's target of 2%. So question marks very much on the speed of which this is rising. The median is for consensus for it to be maintained at that level. I would say that this is probably the most influential number that you'll see that could influence movement in the pound on an intraday basis. So definitely could throw out a trading opportunity when this number comes out at 9:30 this morning. A couple of headlines just to put the inflation situation in a bit of context in the UK. So overnight you had some retail sale updates from the BRC. So that's the British Retail Consortium, if you don't know what the BRC is. And it said that UK retail sales dropped the most since 2011 as consumers feel the squeeze. So this is that whole argument that we've talked about, how the price of goods is putting pressure on household incomes, which means that ultimately people are spending less money, and retail sales on their measure the weakest since 2011. There is one small detail with that though, is the survey period of which it's measuring and where Easter actually resides. And so Easter last year would have been encapsulated over the period of March, I believe. So that would have been then, it would have hiked the data up during that period. And then this time Easter is back into mid-April. And so the timings of Easter can have a seasonal effect on the performance of numbers. So looking at a year-for-year comparison isn't actually always true. So therefore, you know, don't always believe the hype that you read in the news when there's these statistical anomalies that are quite explainable. So I wouldn't buy too much into that, but it is a continuation of the theme that we've become accustomed to in the last couple of months. I've got some bad news for smokers, but some good news for people who like Marmite. And that's because one of the things that you're seeing is the way in which this price inflation is being fed through to the consumer. And basically what's happening is that because of the competitiveness of, let's say, high street supermarkets, they're finding they're unable to raise prices for staple goods like milk to Marmite, because basically they're in competition, you know, Morrison's, Sainsbury's, all these Tesco, all these other names, that these staple goods that every household would regularly need to stock up on and buy, they can't actually lift the prices on those goods because they'll just lose a large amount of business. So what they have been doing is subtly hiking prices on other types of goods quite substantially. So rolling tobacco prices have gone up to nearly 40% from October 2016 to March 2017, where we are at the moment. So if you want to quit smoking, I suggest now's a good time. You'll save yourself a few pennies. If you're looking at decorative candles, you're going to have to tell your wife that I'm sorry, you're going to have to put up with the smell. No more decorative and smelly candles. They're too expensive. Prices have gone up 30%. I'm sorry, love. You're going to have to lump it for the greater good. You know, going down though all these different things, you can see where it's more subtly. They've tried. Supermarkets have been putting up prices on the. You know, this is what's really feeding through into this inflation argument. You might not see it with your bread and milk and sugar, but you certainly see it in some of these other goods, which is becoming apparent. So that UK inflation number will be key. If we have a look at the chart of where cable is trading at the moment, it's nothing really near-term technically that looks too interesting. Certainly, though, this data does have the propensity to weigh quite heavily on the price of the pound. So I guess near-term upside, you're probably looking at retesting the overnight Asia Pac high that was seen at 24.55. Then you've got R1 at 24.63, which probably matches up with that low point that was seen on the 5th, pretty much to the T there on the upside levels. And then on the downside, probably targeting then 124 psychologically, the handle, which also marries up with the S1. And then downside, you've got the low point that was seen at the end of last week at 123.86. So they're kind of the levels that I would look at, upside and then downside respectively. Certainly if the number is out of line enough, then it will have, those levels aren't out of the realm of being tested. I would say more broadly speaking, the market tends to be have a preference for positioning itself for upside surprises, and so therefore a downside surprise is probably not as well priced into the market, and therefore net would cause a bigger reaction. And so definitely a move down to 24 and beyond couldn't be ruled out, let's say hypothetically, if we were to get a number back down to 2.12%, which would be a big surprise. Other number, going back to the calendar that we're looking out for this morning, is the German ZEW economic sentiment. That comes at 10 o'clock. That is one of the more important numbers, I'd say, for the Eurozone, and therefore default the European assets, Euro, DAX, Bund. You should be keeping an eye on those when this number comes out. This is probably second, though, to IFO. They are very similar in terms of soft economic data, forward-looking, trying to gauge sentiment over the next 6-month period. The ZEW is that sentiment feeling over the next 6 months from analysts' expectations, whereas IFO is from actual companies. And so with this figure, it's been fairly consistent. The previous figure at 12.8. If we look at the consensus reading for today, it is for a mild improvement, but largely the same type of number. So definitely be on the lookout for that number at 10 o'clock. Otherwise, the US afternoon is pretty quiet, so I would suggest still monitoring those risk assets like the yen and gold for sentiment read across into the US session, for how the markets are perceiving this ongoing Syrian situation and the dialogue between the G7, which is still ongoing in Italy, and what their intentions are for what they want to do with Russia going forward. Obviously, any commentary out of Russia themselves needs to be monitored very closely, as to does anything out of the likes of Iran, and also any tweets from Trump. That's still very much at the forefront. At the same time, crude oil still looking relatively well supported. If we look a little bit longer dated, that was the Syrian strike spike. We got above that yesterday. We breached $53. We've come back to pivot this morning, and now using that $53 level as a bit of a support for another push on the upside here. That 53 obviously was containing some of the upside before we eventually breached it in the US late hours. And so crude taking a bit of a bid at the moment, back to flat on the session. So I'd be keeping on 53.23, that overnight high, with R1 upside 53.46. There has been a little bit of attention as well on Libya about a production outage at one of Libya's largest oil fields has also occurred in the last kind of 12 hours as well, which is likely just adding a bit of support to this overall bid tone on the general connotations from the geopolitics ongoing. Okay guys, going to leave it at that. So have yourself a great session ahead, coming up to 9 o'clock. Any questions or anything like that, then please feel free to just drop them in the chat room. But have a good session. Thank you.